in this market, as the volatility today comes due with opportunity, how do you assess risk? And what is your risk tolerance, and how much you're always willing to lose without losing your smile?
That's a great question, and especially as people are looking at what's happening in the economy, where interest rates going, is there going to be a potential recession? I think what's nice about our investment strategy is we have a longer-term outlook on where we invest. So we can hold companies for 3 to 5 to 7 years, and you can sort of hold out over those cycles. But I would say in general, where we're really focused on is picking high-quality sectors that are less cyclical, that will be performing regardless of what kind of cycle hits. So, avoiding things like commodity price exposures, avoiding things like consumer discretionary sectors, and focusing on areas that are a little bit less easy to transition away from, like medical or healthcare end market products or services.
Yeah, we take a different view in that we kind of look at the macroeconomic environment, and based on where the macroeconomic environment is, we make different investments. So in the end of 2008, 2009, 2010, we were buying real estate. We bought a lot of real estate in Miami commercial. After the hurricane in Puerto Rico, when valuations were down, we got real estate really cheaply there. And then we kind of feel like you want to buy low and sell high. So we feel like right now we've sold out of everything we have in Miami. It's all-time highs. We've made multiples of our money that we didn't think we would in such a short period of time. And we're kind of converting to cash, and we want to definitely be sitting on a chunk of cash because we think this cycle will come to an end. And if you look at EBITDA multiples over the past 20 years, I mean, you went from a norm of 5, 6, 7 to 15, 16, 18, 22. I mean, there are companies where comps are trading at 22 times EBITDA. Now, we just don't think 22 times EBITDA is a sustainable multiple for the next decade. And so we want to have cash because we think in a bad cycle, it's not going to be 5 times EBITDA, it could be 4 or 3. And we want to have the cash to buy those businesses, because when you get to that cycle, a lot of people don't have the cash to actually execute, and we think that cycle's coming. So the way we're looking at the volatility is to be really disciplined, and to be really disciplined as we look at opportunities and remember that we want to be, number one, not highly levered, and number two, have some cash to take advantage of opportunities when they do arise, and they will arise over the next 5 years.
Yeah, a lot of our families take 20%, 25% of the foot off the gas or stomp it down harder based on trends, but they're always making progress and looking for deals. And they'll be maybe the trusted group who's trusted with the capital if the market starts to go down or does go down. But a lot of times they have ways to add value to platforms or gather up assets and package it for private equity to buy. So they can make money when the market's going up or down, and they're not sitting out and waiting for 5 years for things to get better. Has been my experience.
Is there any macro risks that people aren't talking about right now, like the unemployment, where interest rates are going, and inflation, that you kind of think is going to be prevalent and influential moving forward?
Yeah, I'll take that. So I think, there's obviously a whole bunch of macro risks today. You just mentioned a lot of them. I think one of the greatest areas of risk that people are not talking a lot about these days is geopolitical risk. I mean, obviously people think about Ukraine, Russia, but there's conflict potential in Taiwan. There's the possibility of China overthrowing its government based on how poorly they've handled COVID. There's issues all around Africa, Latin America. You saw what just happened in Peru, for example. Cancellation of some mining contracts, etc. So there's geopolitical risk everywhere. So I personally think we are in an extremely risky situation. The economy, which has been propped up by cheap money for a very long time, everyone thinks, the Fed's almost done hiking rates, but actually they've only just started taking money out of the system. So it's not rates that really matter. It's liquidity. It's the central bank balance sheet that really matters. That process has just started. There's great income inequality issues in pretty much the entire Western world. So there's just boiling with social troubles sort of all over the world. And so, not to be an Eeyore, but I think it's a pretty tough environment.
Right, like Ray Dalio is respected as one of the smartest, global macroeconomic, but also very accomplished, hedge fund managers in the industry, and he would agree with similar things on the disparity of income and the issues that you're talking about. So, great.